everybody to the trading psychology and discipline webinar with Thomas. I'm Thomas. I will be the one hosting the webinar today. And during the webinar, feel free to ask if you have any questions. There is a question box, and you can ask what question you have, and I will be happy to answer the questions. A little bit about myself. I'm working as a senior account manager in AvaTrade for the past few years, and I had the opportunity to work with many clients and many traders, and I'll be happy to share with you today some of the main questions that are being asked and some of the major mistakes that traders are having, and I hope that the experience will be helpful for you and for your journey. We start with the risk disclosure. Any capital markets and trading information disclosed in this webinar is provided for informative purposes only and should not be constructed or applied as investment advice, recommendation, or suggestion. CFDs are a complex trading instrument and come with high risk of losing money rapidly due to 57% of retail investor account lose money when trading CFDs with this provider. You should consider whether you understand how CFDs work and whether you can afford to take the high risk of losing your money. Please read our full risk disclosure statement on AvaTrade.com official website. So for today, the webinar agenda, this is an ongoing webinar we are having on a weekly basis, and it's up to you if you want to focus on a specific subject. We normally go through the WebTrader profit and loss calculation, different type of order, trading psychology in general, what is trading psychology and the importance of trading psychology, risk management, money management, opening, closing trades, different account types and benefits, account metrics, hedging, and education and general improvement. Also, this is the WebTrader page. I know that some of the traders, they have a preference to use the MetaTrader app where they can trade on the MetaTrader either via computer or either via phone. It's entirely up to you if you want to use the web or if you want to use the MetaTrader, or you can even use both. The main difference is that the WebTrader have extended the amount of features that are not available on the MetaTrader. So I personally recommend that you have both. So you can download MetaTrader app on the phone, on the computer, and also have the AvaTrade app on the phone and the WebTrader also you can use on the phone or on the computer. The difference between you have two types of MetaTrader, MT4 and MT5. Majority of the available stocks are only on MT5 tradable. Okay, so if you like to trade stocks, you will find them on the MetaTrader 5 platform. Okay, and for example, you see here when I click on stocks, for example, Canada, I have here different kind of stocks available: Aurora, Cannabis, Bank of Commerce, Bank of Montreal, Berry Gold. So different kind of stocks available. Currently the market is closed. When I click on the instrument details, you can see here also the market opening hours and the more information about the instrument itself. But in general, for you to know if you like to trade stocks, you have more available options on MetaTrader 5 compared to MT4. Also on MT5, we have a trailing stop that does not available on MT4. So here you can see you can divide the instrument by different categories: forex indices, crypto, commodity, stocks, and then you can see all the stocks that are available. This you will only see on MT5. Okay, if you will be on MT4, you will not see it. And then you can move to the other one. This is an example for some of you who like to trade on stocks on CFDs. And you can find here some different ideas, depends on what you like to trade on. You can see here some more countries: Italy, UK, US. Same thing applies to commodities, crypto, indices, and forex. So as we mentioned, this is the page of the web. These are the key metrics for the account. I already mentioned it in our previous webinar, the difference between balance, free margin, equity. If you still not really understand, you can let me know. I'll be happy to explain again, or you can visit our previous webinars. Also the same metrics here: use margin, margin level, margin increase, all of that we spoke about. Hedging, what is hedging, the benefits of hedging, and also this is something that we have discussed in our previous webinars: how to hedge and what happens when you hedge a position. For example, this is an example for the new order page, how it looks like when you click here on an instrument. Let's say today we give some examples on stocks, because normally we don't talk a lot about stocks. So let's say you click Germany, buy or sell, and then you see the new order page will open right here. Okay. And also we mentioned previously the margin impact, what it represents, the lot. If you guys would like to recap the basics, you can let me know. I'm just recapping everything that we spoke about previously: buy and sell, the difference, the lot size, the margin impact. The AVAProtect is also a feature we offer. What are the requirements? How do you open a trade with AVAProtect? And how does it work? Different kind of examples. We also covered the pending order, how to set up a pending order, execute when price hits. That's how it's called on the WebTrader, and on the MetaTrader is just a regular pending order. We discussed also the take profit order. And here's some examples. And we also had some open positions from our previous webinar. You can see that we basically hedged the position with quite a big amount of volume. The reason why I shared with you these two positions, you see, I'm basically losing money on these two. I'm losing about $5,000, $5,500. But what you can see that these two positions are very big positions. Okay, one is in a loss of 29.6 thousand, and one of the position is in a profit of 24,000. What happens when I close this position with 24,000? You will see the balance will be adjusted accordingly from 12.9 thousand the balance jumped to 37,000, okay? Because of the fact that the balance represent the closed positions, your closed positions. Now I'm fully exposed on US Tech 100, 50 lots sell, okay? So instead of losing that amount, I basically made a profit on one position. And the other position, I had a loss on. So now I will share with you again. The same hedge we had before. We have a buy position here. So here we are fully hedged again. What happened? Sell position. The price went up. And therefore we have a loss of 30,000. The opening price is 24,793. Sell direction, meaning that we thought the value is going down, but on the contrary, the value went up. Okay. So essentially, you can see the price is 25,372. Okay. Now you might be asking why I open a buy position entirely to. The reason why I set up a buy position is entirely to just show you the purpose of hedge and how to hedge a trade. Okay, when you hedge a position, you're limiting your losses. Okay, here we are already losing 30,000, 29.4 thousand, but we didn't really lose the whole 29,000. Why? Because we had a hedge position that was making us 24,000. So we lost in total 5,000. Okay, and this is a tool that you use in order to have a certain limitation of your losses. This is how you can limit your losses, but also there are other ways to use it. For example, if you want to secure a better pricing point, so you see what happened, the value of this position, it dropped, okay, and we are in a loss of this position. What you could do, you could place another position now on the same instrument. Instead of hedging this position, you can just secure a better pricing point. So this is obviously entirely up to you, depends on the strategy that you're having. But on our next webinar, we can also see what is happening with these two positions. And we remember that we still have a certain loss here, but now we have a certain limitation that we set to our loss by hedging this trade. On the contrary, we could also just set another sell position, and then we secure a better pricing point, meaning the opening price here is 24,793, and now you see the price is higher, 25,372. Okay, so that's why it's a better pricing point for a sell position. And so again, we're going through the subject of hedging. This is an example for hedge. Instead of me losing on this position 29.7 thousand, I only lost 5,000 using my my hedge, the other hedge position. So this is an example for your reference, and also if you go on your history, also you can see here the history of the trades that we've done also in the previous webinar. You can see here one loss 400, 300 profit, 1K, 2K. These two positions we made a little profit on. So altogether, we open up the calculator. can see 24 plus, let's say 2 plus 1, approximately is equivalent to $27,000 profit, as it say here, the total profit. And actually on the open position I have here, a loss. So I'm still in a loss, but obviously this is something that you should be familiar with. It is also related with the psychology of trading, because a lot of traders are basically trading without having the relevant knowledge and without having the relevant tools that will enable them to have a certain plan for the account, and also to have a certain limitations for the losses. So for us, if we want to have a limit for the loss and to, let's say, reduce our level of exposure, what we can do, we can either trade on a smaller lot size, and when you trade on a smaller lot size, the profit or loss per point is going to be reduced as well, okay? Or either you can use different tools, like we mentioned, hedging, or like we mentioned, let's say AVAProtect. AVAProtect is not really available for this instrument. Is only available for gold and silver. So specifically for this trade, let's say we close them. We already demonstrated the point. What happened when we use a hedge position. Now I want to have enough free margin so I can demonstrate further. Okay, so let's say we go through a certain stock. Doesn't matter which one. Although again, we don't have that feature available on stock, so we'll just go back to the AvaProtect example. Just wanted to share with you. So you see here, let's say I want to trade one lot on silver, okay? It's going to cost me, if I want a protection for 2 days, so it's around 27.1, which is a huge position, one lot, okay? I can't even open this position. So let's say if I have a free margin of 7.2 thousand, I can open around 0.4. Okay, so for 0.4, I need to pay 10.8 thousand to get the protection. Okay, instead of paying, I can close this, and let's say I open whatever position I want. This is 0.4 on silver. One was buy, and let's say the next one is sell. Let's have a look here. I can't even hedge this trade due to the fact that my free margin is a little bit below 100% due to the spreads when I open the position. So we need to take something a little bit below the full exposure for the sake of the example. We go again for silver. Let's say this time we try something like 0.35. This should be okay. Even 0.3. One of the position is the buy. And we open another one. 0.3. Sell. And you can see here, one is a buy, one is sell. Both are losing because of the spreads. We'll give them time to see what will happen. But in general, when you have one buy, one sell, this is called being fully hedged. Okay, you see, we have the same instrument. We have the different directions, one buy, one sell. We have the same size, 3,000 and 3,000. And then when the time will come, one will be profitable, one will be losing, like the previous example we shared in our previous webinar. Okay, so we can have these two positions, let them go, and continue. So for us, the traders, it is important that we have a certain structure and we have a strategy, and each one of you should be familiar with how to set different type of exposures. Okay, so for example, I will share. Let's say we go back to stocks. Now we go to UK stocks. Okay, we choose any preference for you. So we choose the first one. My equity is equivalent to $6,100. Okay. Now, if I'm trading with the minimum exposure, which is equivalent to 0.01 lot, okay, and I want to have a risk on this position of, let's say, let's take the calculator, okay, and do 0.01 multiplied by 6133. It means 1% for my equity is equivalent to $61.33. Okay, so if I want to limit my loss, I want to have, let's say, take profit is profit, but in general the values in percentage is the same. Okay, so if I want to have, let's go just to the stop loss. So 0.3. If I want to have a loss of 61.3, the system will tell me when the price reach 3234, this is the amount of money that you will be losing, okay? Which is equivalent to 1% from your equity, okay? And for you, the trader is important because you need to know what is happening when you open a trade. It's very important to look at the lot size because many traders, they don't really realize what is the potential gain or potential loss they're going to have when they trade over a certain percentage or when they take a bigger position, a bigger exposure. Okay, so let's say 0.1 lot. We're using a multiplier of 10 times more. So now you see the price 3641 it's closer, it's way closer to the current price because we are using the leverage and we are increasing the profit or loss per each point. Now, if we go to one lot, the price is getting way closer, 3681. You see? So what we learn from this is that if we trade on a bigger exposure, it will take less time to get to a certain pricing point that we set in advance. So if we have that loss that we want to have of 61.3, it's not even possible to set it due to that. So you can increase it. 3683. Let's try to take one of them. Let's try to increase this one a little bit to 100. Check the margin. So specifically here you see the free margin. We don't even have enough margin to place this specific order. Okay, so the point here that I'm trying to make is that as a trader, you need to know what type of risk you want to take. Okay, some of the traders they tell me, Thomas, I love high level of risk. I understand that if I take a bigger risk, I have the potential to make a bigger amount of profits. And basically, they are determining in advance that the risk level for the account is higher. Some other traders are more conservative. They are okay with trading on a smaller exposure to have a smaller level of risk, smaller level of profits, more conservative. Okay. And also there are people who in the beginning, of course, and they don't really know what is the basically potential or potential gain, potential loss when they are trading with a bigger lot, with a bigger exposure. So I think that each one of you should know from now on, when you get into a trade, you should know what are your expectations from the position. Okay, this is very important for the subject that we are talking about, the psychology of trading, that you have awareness of what is happening with the account. You know how much money you are planning to risk. Okay, and obviously it's something that is entirely up to you. You decide what is your level of risk, and obviously you can take advantage of that as well. And when you are trading, to enjoy um, having a certain subconscious decision regarding your account. So the subject that is very important, which is the psychological factor of trading, is determined by a lot of different subjects that we have discussed in one of our previous webinars. And you can also always visit and watch our YouTube channel to see the previous recordings. And I will also go through it again in our next webinar. So these are more the psychological factors that are causing you, the trader, to behave in a certain way, like overtrading or a certain fear of losing more money than what you have already lost. And I suggest to each one of you to have a certain journal of your trading, to stick with a certain pattern that you set yourself. You can do a journal on a Word sheet, on an Excel sheet, on a Google sheet. Even you can write it in a pen and paper on a notebook, okay? And summarize in advance what is the plan for the account. What is your plan? You can type how many positions you want to open a day, how many positions you want to open a week. What is the maximum amount of money you are willing to lose per position? And if you are willing to lose X amount of money, how are you going to close the position? Whether are you going to close it manually? Are you going to set a stop loss? Are you aware that when you are trading with a stop loss, we don't provide a guarantee for the stop loss? So sometimes it happens when there is a certain gap, when the market is not giving you the exact available price that you have requested for your stop loss. So for example, if you set the price for 3683, the position can close at the next available price, which can cause to a bigger loss than the $100 that you have initially set for the stop loss. Okay, so you don't have a guarantee for that amount that the position will close exactly at this price. But as you can see, the majority of the times the position will be closed exactly at the price that you set. Okay, you can see it also on the history, on the trading history, and it will tell you what is the reason that the position was closed. whether it was closed due to stop loss, whether it was closed due to a take profit. And also it is important for you to realize the importance of a rollover. Any of you know what is a rollover? So a rollover is also something that is important to realize. It is not something that happens often. It's not happening daily. It happens monthly. Okay. You can also go to AvaTrade.com and you see a magnifying glass on the right top, and there you can type rollover, and it will give you the rollover dates. Okay. And there you can see when is going to be the next rollover and check if the instrument that you are trading with is going to have a rollover. Okay. And what is basically a rollover? It's some of the trading instrument that you are trading with. You are trading on a future contract, so therefore on a certain date the current traded contract will be replaced with the next traded contract, and then there will be a rollover adjustment made in the account between the price of Friday when the market closes and Sunday of the rollover date. So it's not every Friday, but it is the Friday closest to the rollover date that you see on the rollover date list. Okay, and this is something that many people are asking, why do I have a rollover adjustment on my account? And the reason is because you had a rollover. Okay, if you don't want to have a rollover, you can close the position before the market close on Friday. Again, not every Friday, just the Friday closest to the rollover. Okay, and then you will not have any rollover adjustment. By the way, the rollover adjustment is not positive or negative. It depends. It can be positive or negative, depends on the difference between the contracts. Okay. For example, okay, if you have, let's say you're trading on one lot on crude oil. We show you crude oil. Let's see the current price is equivalent to $64 per barrel. So let's say the market closes again the rollover dates will appear on the website. Okay. Now let's say, theoretically speaking, you know the rollover date will occur on Sunday. Okay. And you see that the current price of crude oil is not relevant for the calculation, but assuming the price closes with $60 per barrel, okay, and you had one lot open on crude oil, the market closing price on Friday will be compared with the next traded contract price on Sunday, and the difference between them will determine what will be your rollover adjustment. So if the closing price was 60 and the next traded contract will be 65, this is a difference when the market is closed. Is an adjustment we are doing. If you had a buy position, it means that you are making $5 per barrel multiplied by the amount of barrels. You are making $5,000 when the market is closed due to that adjustment. In that case, you will have a negative rollover adjustment in the account of 5,000 because the market was closed at $60 per barrel, and then the market opened at 65 on Sunday, and this difference is $5 per barrel. But if you had a sell position, okay, and again, let's assume the price per barrel was closed at $60 on Friday, and on Sunday, the next traded contract opened with $65 per barrel. Again, we have $5,000 difference, but this time you will get a positive rollover adjustment because you are going to have a loss on your open position of $5,000. $60 is the closing price on Friday when the market is closed, of course, and when the market opens with $65 per barrel, we have $5 per barrel loss. If you had one lot is equivalent to 1,000 barrels, and this is the calculation. I'm talking about this subject because this is a subject that is repeated, and clients don't really understand what is happening many times. And it is important to understand if you don't want to have the rollover adjustment, you can close the position before the market closes on Friday, not any Friday. Friday closes to the rollover. Okay? And every one of you can go to the website, avatrade.com, click on the magnifying glass, and then type rollover, and you see the rollover dates. So this is something for you if you would like to understand, because I know that a lot of traders, they don't really understand that concept. And then you decide. This is also the psychology of trading, that you know what you are doing, and you are making a conscious decision whether you want to have the position rollover, you don't want to close it, or you want to close it before the rollover date, so you won't have any rollover adjustment, and then you can reopen the position when the market opens with the next traded price. Okay, so I wanted to discuss this subject because from my experience, this is something that a lot of traders, they don't really understand what it is, and it is substantially important for traders to understand the rollover concept. Additionally, what else? We discussed previously the swap, the overnight interest that is also accumulating on the account when you are trading after a certain time, normally around 10 GMT plus 1, then you will be charged with the overnight fee. This is something I can explain to you. It depends on the amount of days you wish to open. Also, some of the days will be considered as free swap days for the days that you will not be charged with the swap. Okay, so it is also important to understand that when you are trading and when you are holding a position, some of the fees that you will be charged is called swap. Swap is an interest. It can be positive, it can be negative. It depends on what you are trading. Let's give an example on crude oil. What we see here, overnight interest yearly for buy and sell is the same, is negative 4.5%. Okay. If we check on something else like gasoline, instrument details, the overnight interest 4.5%. Let's look at something else. Let's look at let's say US Tech 100. US Tech 100. Gold. Here you can see that for the sell, you get a positive interest. So if you hold a position on gold and you sell it, you will not pay the swap fee because it's positive swap interest. Okay. and on the buy position, you will pay 9.5% annually. If you go on some more exotic pairs, for example, the USD ZAR, can't remember what is the swap rates for this one, but yeah, I assume here you see it's 4.02% annually, okay, and it's 0.2 negative annually for the sell position, okay. So what we learn from this is that when you are holding a trade, you should also take into account how much money you have to pay for the overnight interest, okay, and you should also take this into account. You can ask an account manager, please help me to calculate what will be my swap fee if I want to hold the position on whatever you want to hold, and for how long you want to hold, and also what position size you want to have. Okay, so I think today we went we discussed a little bit about rollover, a little bit about hedging, a bit about swap. We can also discuss spreads. I will show you, let's say the USD MXN. Okay, so how does the spread work? The spreads in AVA are floating spreads. Okay, it means that we have the base spread. Okay, that this is a certain amount of funds or a certain amount of pips that is fixed. Okay, and according to the market, when the market is more volatile, the spread will widen. They will widen above the base spread. Okay, so when the spread will widen above the base spread, they will also shrink back to the original spread when the market is less volatile. Okay, so this is also something that is important for you to know. Also, this is the difference between the bid and the S, the buy and sell price. And if you go to the website avatrade.com before you log in, trading info, and you click financial instrument, you can see the base spread of each instrument. Here you can see the actual spread. Okay, it's not the base spread. Let's say if you click euro dollar, let's see what's the spread right now, 0.8. Okay, so 0.8, it's 0.8. This is the base. Okay, now if we look at gold, because of everything that is happening with gold, I'm sure the spreads are widening. You see 1.26. Okay, so the base spread here is lower than 1.26, is equivalent to 0.2 something. Okay, this is the base spread on gold, but because of the market spread are higher and the market is volatile and everything is happening with gold, so currently it's higher. So it's up to you. You can trade on instruments that offer the base spread, which is cheaper, like what we just shared with euro dollar, or obviously you can keep trading when the market have the floating spread, and take into account when the market volatility will shrink, and the value of the spread will also shrink accordingly. So I hope you enjoyed the webinar today, the trading psychology. If you have questions, you can feel free to ask any question you may have. I'll be happy to proceed another webinar next week and share with you more about the common mistakes and common questions that traders are asking. And I hope you enjoyed the webinar, and you can feel free to let me know if you have any other subject regarding that main subject that you would like to discuss. And I wish you all a lovely weekend and successful, profitable trading journey with AvaTrade. All the best, everyone. I hope you enjoyed the webinar today. Bye for now.